All right, let's dive into United Nilgiri Tea Estates. This is a really interesting microcap with a story you don't see every day. We're going to break down what the source material says about its unique dual-engine business model, look at both the bull and the bear arguments, and then see what the final verdict is. Okay, so let's kick things off with the technical chart. And wow, take a look at this. What you're seeing here is a stock that's basically been stuck in a long consolidation, like a really long one, all the way back to 2015. Now it's making another big push, trying to break through that key resistance level right around 550 rupees. For anyone watching the charts, a solid monthly close above that number is a huge deal. It could mean the stock is finally ready to start a new, sustained run after being quiet for so many years.
So you see that action on the chart, and you have to ask, right? What's the story behind it? What's driving this move? Well, it all boils down to the company's really fascinating business model, what the analysis calls a dual-engine setup.
Yeah, this dual-engine model is really the heart of the whole investment thesis here. Think of it like a hybrid car. On one hand, you've got the high-octane growth potential from selling an agricultural commodity, tea. But on the other hand, you've got the steady, reliable power from commercial real estate. And that's what makes it so different. You just don't find this kind of strategy in a microcap in the Indian plantation sector. Most of them are just completely at the mercy of volatile commodity prices. And this visual here just lays it out perfectly, doesn't it? You've got the commodity upside, the excitement and potential profits from tea. And then you have the real estate safety, that solid defensive foundation. It's this mix of growth and safety that makes the model so powerful. Now, this chart really drives the point home. See that jagged up and down line? That's the reality of the tea business. It's volatile, with crop cycles and changing prices. But then, look at that smooth, steady line climbing upwards. That's the rental income from their properties. It acts as this amazing hedge, this financial shock absorber, making sure the company's profits stay resilient even when the tea business has a tough year. Okay, so now that we get how this innovative model works, let's dig into the bull case. We'll look at where the growth is coming from and just how strong this company is financially. So here's the first key thing to understand. United Nilgiri isn't just selling any old tea. They're not playing in the mass market at all. Instead, they operate in a high-margin luxury niche. They use the unique environment of their high-altitude estates, their special terroir, to create premium stuff like frost tea. This kind of product sells for way more and lets them sidestep all the price craziness you see in the bulk tea market. And that focus on quality, it translates directly into pricing power. You can see it right here. Their main brands, Chamraj and Korakundah, get a huge premium in export markets like Russia and Iran. Why? Because there's a real hunger for top-notch orthodox and organic teas. And when you compare those export prices to what they get domestically, wow, the difference is just massive. Now, what makes this whole premium strategy possible is the company's rock-solid balance sheet. I mean, get this. They've had zero debt for more than 5 years, and they're sitting on a pile of cash. That kind of financial discipline gives them a huge margin of safety, especially when you compare them to other companies that are loaded up with debt. And this financial strength shows up right on the bottom line. The company posted a really strong 17.7% jump in net profit year over year, hitting 5.32 crore rupees in the third quarter. That's a great sign that they're bouncing back strong from some of the weaker prices we saw earlier in the year. So what's the plan going forward? Well, management has a really clear 3-part strategy. First, keep expanding into new export markets. Second, keep building up the brand's premium image. And third, squeeze every last drop of value out of their real estate assets. Simple, focused, and powerful. But of course, it's not all sunshine and roses. A good analysis has to look at the other side of the coin. So now let's flip it around and talk about the risks and the key points from the bear case. The source material really flags 3 main risks here. First up is rising wages in South India, which could definitely put a squeeze on their profit margins. Second, you gotta remember this is a microcap stock, so liquidity is low. That means the price can be pretty volatile, swinging up and down. And finally, you can't escape the fact that tea production is, by its very nature, a cyclical business. And there's another big one on the horizon for the whole industry. The EU is rolling out much stricter pesticide rules. Now, for a lot of exporters, that's a huge headache. But here's the interesting twist. The analysis points out that United Nilgiri might actually be in a great spot. Why? Because their Korakundah estate has been organically certified for years. This could turn a major industry risk into a huge competitive advantage for them, letting them scoop up market share from others who can't meet the new standards. All right, so we've seen the good,
we've seen the bad. How does this all come together when we talk about the stock's valuation? Let's bring everything together and see what the final call is from the source analysis.
So, according to the analysis, the stock is trading at a PE ratio of about 10.7, and the take is that this looks pretty undervalued, especially when you think about everything we just talked about, that asset-heavy zero-debt balance sheet, the premium brands, and that stable real estate income. It seems like you're getting a lot for that price. And that brings us to the final verdict from the report, a compounder buy. What that means is they see this as a solid pick for long-term investors, suggesting a buy on dips kind of strategy. In the end, it all comes back to that really unique and powerful mix of a luxury tea business with that real estate safety net. So, I guess the big question this leaves you with is this. Is that dual engine model strong enough to power through the risks and keep on compounding value for years to come?